Hi, it's John Kelly. In this module, we are going to discuss assessing the risk of material misstatement. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, assessing risk of material misstatement is probably one of the hardest things the auditor has to do. My first piece of advice is if you sit down with a file and start thinking about the audit and start trying to decide on high, moderate, or low for the audit, you will in the end decide that everything is moderate. You're not quite sure why, but you're worried and you're going to assess it as moderate. I refer to that as moderate disease. So let's not do that. Now let's think about this. You're an audit assistant and you're off to do the audit, and as you rush out the door, you are told that, risk of material misstatement of accounts receivable is high. Now what are you going to do? Are you going to send out a lot of confirmations to address existence? Are you going to check the allowance for doubtful accounts a lot to check valuation? Are you going to recalculate the sales taxes on a bunch of invoices? I guess that's also valuation. Are you going to agree a lot of invoices to shipping orders? Existence? What are you going to do? You really don't know. So perhaps you stop and say, well, I really don't know what that means. And the person says, well, okay, it's valuation. Valuation is high, and you rush out the door. But you still don't know. Is it that all accounts receivable are uncollectible? There's a problem there? Or is it a particular division that has a problem with uncollectible receivables? Or is it that invoices are incorrectly extended or added? Are sales taxes too high or too low? What's specifically the problem? Now, this is an example that happened to me in real life. Someone came to me and they had assessed risk of material misstatement for property, plant, and equipment, and they'd ended up at high. And they had a long list of risks. They said, well, additions could be expensed in repairs and maintenance, and capitalized items really could be repairs, and assets could be impaired, and depreciation could be incorrectly calculated, and on and on and on. And they were planning on doing a lot of work, but they were puzzled because really not much had changed in fixed assets. And I said, well, why do you think that additions could be expensed in repairs and maintenance? And they said, well, that could happen. And I said, well, what's repairs and maintenance this year? They said, it's $10,000 or $15,000 like it's always been. And I would say, well, that's a risk assessment procedure you should have done. And based on that risk assessment procedure, you haven't found any risk. So risk of material misstatement for property, plant, and equipment stays at low. Now, capitalized items are really repairs. How much did they buy this year? Well, they really haven't had any significant additions, so we'll take that out. Assets are impaired. What do you think about impairment? What kind of property do they own? Well, they've got a single building. They're a distributor. It's a large warehouse. They bought it a long, long time ago. It's been depreciated. They're profitable. They're using the building profitably. I said, well, that goes away too. So the point is, if you're assessing risk of material misstatement for property, plant, and equipment, it is tremendously important that first you have done your risk assessment procedures to find out what the risks are for the particular component, for the particular client, in the particular year. And remember, it can change, and it's changes that are so terribly important when you're assessing risk of material misstatement. So what should we do? Well, we should follow 315, and actually if you read the title has got some great advice. Identifying and assessing the risks of material misstatement through understanding the entity and its environment. So it is terribly important to have a good understanding of the entity ahead of time before you plan the audit, and your risk assessment is based on that understanding. And remember that for a continuing client, we probably know a lot of this. And if we've stayed in touch with our client throughout the year, it shouldn't be a terribly time-consuming task to update our understanding of the client that we already have. Now, things that are to occur, there is to be a team discussion, not a meeting. The standards say discussion. So you don't have to have a meeting. There are other ways to have a discussion other than by having a meeting. And during this discussion, there has to be consideration of fraud, how the financial statements could be materially misstated due to fraud and error. So a discussion of how material misstatement could occur. The engagement partner decides who attends the meeting, and it could be that only the engagement partner attends the meeting, because it could be a small audit and only the engagement partner attends. Or it could be a discussion between the engagement partner and the manager, and the two of them chat for a few moments and decide what needs to be done. So not everyone needs attend. And then the engagement partner is to decide how to communicate the decisions made at that meeting with those who weren't involved. And probably the best answer is if after that meeting and after the risk of material misstatement is assessed, if an audit program is prepared linked to the specific risks identified, that should explain to the person doing the work, person or persons, what they are to do and what the risks of material misstatement were. And the planning discussion really has to be partner-led. It is very hard for novice or inexperienced staff to plan because they don't have the detailed understanding of the client built up over a number of years. Now, what are the steps in 315? Well, we should do inquiry, analytical procedures, and observation. And for instance, in that PP&E example I just talked about, if we had talked to the client, if we had done analytical procedures, if we'd walked around the warehouse and said, gee, I don't see anything added this year, that would have been a big help. We have to know about the entity and its environment, and there's a list. Things like what kind of industry is it in? Are there any risks inherent in the industry? And in most industries, the answer is going to be no. And then finally, we have to consider internal control. The control environment, monitoring controls, for instance, and all other controls. And think about it this way. If you were about to audit accounts receivable and you had no idea how things were sold, were there shipping orders, how were orders placed, how were orders priced, you need to know enough about internal control to be able to plan the audit. And that's the level that we need. And then another really good piece of advice, 315.26c, relate what can go wrong at the assertion level. So you relate the things you found that could go wrong to the assertion level. Very clear that audit procedures need an assertion link. This procedure addresses this assertion, and I want to audit this assertion for the following reason. Very important. So a suggestion for assessing inherent risk or risk of material misstatement, start at low. And if it's a material component and you've done your risk assessment procedures and you haven't identified any factors, stays at low. If you identify some or more factors, you move up from moderate to high, but that's based on a listing of factors that have affected your decision about risk of material misstatement. Also important is if you have an immaterial component that could not contain a material error. Materiality is $100,000, prepaid expenses are property taxes, they are $2,000, they were $2,000 last year. That could not contain a material error. So we will assess that as negligible, and we're going to do very, very little work. We don't need to do a lot of work on prepaid expenses if it's negligible inherent risk. The other thing we've got to do is we've got to understand what we mean by high. Does high risk of material misstatement mean that we're sure there is an error? And perhaps this is what we mean by significant. We're sure the balance is wrong, and we're going to keep going and auditing until we find the error. I think in most circumstances when we say risk of material misstatement is either moderate or high, we go, I'm a little worried about this. I have some puzzlement. I would like to do a little more work than I'm going to do based on low risk of material misstatement. And if having done the additional work I specify, I find that, well, there was no error, I'm happy and I'm going to stop. And I'll decide that, I was wrong. there is no material misstatement. So I think this is what it means. It means we're concerned, we'd like to do more work, but having done the work and nothing is found, we are happy to move on. Now, the CICA extent of audit testing said that they thought that risk of material misstatement of high meant 60% chance of misstatement, moderate meant 50, low meant 40. And that's when we come to think about doing a test at 95% confidence, we're testing far more than we need to test based on risk of material misstatement at high being a 60% possibility of error. We're doing far too much work. So some examples, and the other thing about auditing is it's sometimes difficult to decide when planning happens. Sometimes it happens at the beginning, sometimes it happens at the middle, sometimes it happens at the end. Now, if you're doing a large public company, multinational, many divisions around the world, you'd better do your planning at the beginning and decide what's going on. The smaller the audit gets, if you do your planning at the end of the audit, what's the problem with that? Well, the problem is you may suddenly at the end decide that you found a risk of material misstatement you didn't know about, and you got to go back and do some more work. If you're prepared to accept that risk, then it doesn't matter that you haven't perfected your planning at the beginning. So it's going to depend on what's efficient, and that's going to depend a lot on the client size. Larger the client, more likely that we have to get the planning done earlier. Now, I'll tell you an example of a small not-for-profit client I had. They routinely got a $100,000 grant from a foundation. They sent me their records for audit. I looked at the financial statements and right away went, hey, where's the grant from the foundation? It's not there. It was missing. So I didn't even get past the risk assessment on this. I phoned the client, said, hey, my analytical procedures have pointed out to me that's missing. The controller went, oh, you're right. I forgot that. I will send you the supporting documentation. Yes, we're going to get that grant. It's been approved. It's for last year. I'll send you all the documentation. Please accrue it. So that was adjusted before the audit even began. And I didn't bother considering that in my risk assessment because it was now fixed. Another example, I was doing the audit of a school, and I was comparing repairs and maintenance from last year, which had always been about $5,000, and this year it was $95,000. And I was startled. I went, why has repairs and maintenance gone up? What is this? And I quickly looked in the general ledger and noted there were three $30,000 payments for an energy saving program. So I went to the controller and said, please show me these invoices, saw 3 invoices, and they had changed all the light fixtures in the school to be energy efficient light fixtures. So I thought about that, and I guess my risk of material misstatement here is, should that $90,000 have been capitalized or expensed? And I thought about it, and I concluded, well, they had light fixtures before, they've got light fixtures now. It was difficult to determine any kind of future benefit on energy saving. They were just being good corporate citizens. So I concluded that it would not be capitalized. It was appropriately expensed. And sure enough, when I was presenting the financial statements to the audit committee, the first question they asked was, why is repairs and maintenance so much higher? And I knew it was the energy saving program, so I didn't look stupid. So documentation, in this case, I noted my risk assessment procedure that I had, compared the financial statements this year to last year and noted anything unusual, and this was the only thing I'd noted. I set risk of material misstatement for occurrence of the expense at moderate. I noted that I examined the invoices, and in particular, I documented my conclusion of why I decided not to capitalize the amounts. Now, the truth of the matter is, in real life, these risk of material misstatement decisions are often really, really simple, and just like the 2 I've gone through. And we have to kind of make up a much more complicated example so that we can kind of demonstrate what we would do and document. But please don't think that this means that this is going to be the kind of way you're going to find in every assertion for every client, for every component. So here's my made-up example. A company sells silk flowers, And this year they've got a new line of business selling to new customers completed silk flower arrangements. And to get this off the ground, they have a rebate plan. Everybody gets 10% back on their purchases. But the rebate system is all messed up, system errors. Nobody got paid enough. It's big problems. An external model run in a spreadsheet program doesn't tie to the general ledger. Great big mess. So, what's risk of material misstatement? And which assertions does this apply to? So, the two that I can think of, we have many new customers. They may not pay us. There's a risk of material misstatement of valuation. And we have the rebate plan, and that is also valuation of accounts receivable, because accounts receivable is too high and it's going to have to be reduced by the amount of the rebates that we haven't recorded. So we've identified two risks of material misstatement. They both affect the valuation assertion, but they both affect the valuation assertion in different ways. So as we design our audit procedures, we're going to need a slightly different approach for each of these two risks, even though they both affect valuation. And what might our procedures be? Well, perhaps if we're doing this planning at an interim date, perhaps what we're going to do is say, well, please do an analytical procedure at year end and see what days sales receivables are, and see if there's a whole bunch of old receivables for the silk flower arrangement customers, or see whether it's the same now as all their other customers who all pay very, very quickly, and there is no extra concern on valuation of silk flower receivables. Or maybe we'll decide to test the collectability of accounts receivable. The rebate plan, I really don't want to do detailed testing on this because it's not going to work and it's going to be horrible and time consuming, and we know that everything's already wrong. Maybe we can get away with a simple analytical procedure and say, well, what are 10% of silk flower arrangements for the year? What's 10% of sales for the year? And how much has been paid out? And we'll just accrue the difference. We'll get the financial statements right. We won't know to whom the rebate is payable, but the financial statements are right and the client can sort it out over the course of the next year. So our risk assessment might look like, we'll say the component is accounts receivable, and we've listed our two risk factors there. We've hooked the risk factor we identified to the assertion. So we didn't find anything on existence, so it's low. And rights and obligations, we'll make some stuff up about this client. There is no bank debt. They have no loans. They don't factor their receivables, so can't think of anything that constrain rights and obligations. They own their receivables. So I'm going to put that as negligible and not do a lot of work. Completeness, haven't found anything. It's low. Valuation, however, is high. And I wish to specify some audit procedures to deal with valuation being high. Now, the other important tip here is don't audit last year's risks. Let's assume it's now next year. And we looked at the collectability of silk flower receivables and it was fine. Don't leave that risk assessment there this year as moderate for new customers, because we now know, having gone through a year, that that isn't in fact a problem. And one of the things you will find in audit programs is we keep coming up with risks, finding that they're not a problem, but those tests never leave the audit program. So remove them next year and don't audit last year's no longer existent risks. A good example of this, by the way, is Ligand Pharmaceuticals. In the audit plan, at the beginning of the audit plan, they identified overall risk due to events related to product sales and sales returns. And they said, we should really do a bunch of work on this because we're concerned that there were going to be a bunch of sales returns after year end. They planned to do the work and they didn't do it. And their documentation let them down. So don't ever document a risk of material misstatement any place other than, like on that piece of paper we saw in the previous slide, which says, here's my assessment of risk, here's the assertion that affects, and here is my link to my audit program to make sure that I do the amount of work necessary. So their documentation let them down. The PCAOB got mad at them. You can read about it there. It was just a very sad story. They identified the risk correctly, but then forgot to do audit work. So what are we supposed to document? We're supposed to document the team discussion as needed, and we document the decisions, and please document them all in one place, not randomly throughout the file. Document them all in one place so you can make sure that your audit work addresses them. We should document key elements and controls and risk assessment procedures, and probably some combination of checklists and documentation in the working papers. We'll deal with that. Risk and material misstatement at the financial statement level. That's going to be overall risk, and we're going to do things like be unpredictable and have appropriately experienced staff, so we presumably can deal with that in a checklist step. If the risk and material misstatement at the financial statement level also affects an assertion, move down one line and now include that in the assessment of the risk of material misstatement at the assertion level and significant risks in the same place at the assertion level. So, a checklist will probably help us to remind us that we did all the required procedures, and if those required procedures brought exceptions to our note, we will document those, and that documentation of the exception then proves that we did the required procedures, all in one place, not all over the file, so they can be addressed as needed by 315 and 3. So, thanks for listening.